The Wisconsin Realtors Association is pleased to present this virtual conference session entitled, The Taxman Cometh, the Power of Planning in a Real Estate Career. We are very pleased to welcome all of you to this session. And now it is my pleasure to introduce today's moderator, Kathy Zimmerman. Kathy, welcome to the program.
Thank you, and welcome everybody. I'm Kathy Zimmerman with RE/MAX Community Realty. I'm the broker-owner of that company. I'm also a WRA Real Estate School trustee. One of the responsibilities of the Real Estate School is to provide interesting and informative education programs to help you in your business. Today's session will be full of valuable information, guaranteed to help your business. So I hope you take advantage of it and the knowledge our speaker can offer. Feel free to ask questions at any time in the chat box. I'll do my best to work with our speaker to answer them during our time together. If we are unable to answer all the questions, we will respond after the program. So without further delay, let's get started. It's my pleasure to introduce our speaker, Travis Everette. And for those that haven't been in previous sessions, I'll just tell you a little bit about him. So more than 2 decades ago, a farm boy in North Carolina decided he wanted to play football and be a doctor. The beginnings of a life story anyone could be proud of. But after attending the University of North Carolina, that farm boy realized he was as bad at medicine as he was at football. What he did excel at was talking and helping people. And so a real estate agent was born. Now the owner of a successful real estate school, a national speaker, and the founder of a brokerage firm of over 120 agents, Travis really only wants to know one thing. What can he do today to help you succeed? Take it away, Travis.
Thank you so much, Kathy. I'm sorry you had to read that yet again. Kathy's following me around, and she's going to know more about my history by the end of today than I do, having to read that. They should make it about 10 minutes longer, and then I wouldn't have to work so hard on these. Sit back and listen to you read. So, yeah, she's tired of introducing the guy from North Carolina, I'm sure. Yes, I am from North Carolina. The accent gives me away pretty quickly. So I definitely cannot claim to be from Wisconsin, though today I am pretty thankful for that because it is 62 and sunny here, and I know you guys are hunkered down and not probably enjoying the snow, but at least this technology allows us to do this in a way that you don't have to come outside, and I think a lot more people could maybe partake as a result of that. So it's a good deal that they plan to do this as a virtual conference this year. This presentation is all about taxation, and we're going to be looking at taxation and specifically federal income taxation for you all as business professionals, as real estate agents and licensees, and talk about how the changes in tax law might impact you and bring you either angst or relief, depending on your particular situation. And so we want to go through those. One of the things I certainly have to caution you against is I am not a CPA. I'm not an attorney, and so nothing in this presentation is advice about how you should handle your personal tax situation. But at the same time, this is useful knowledge that I think a lot of professionals can benefit from, and so they wanted to have it included in the presentation for today. As we talk about taxation, one of the first things that comes up as sort of a topic that needs to be expounded on is how we are structuring ourselves as a real estate licensee or a broker owner, depending on your situation. Are you structured as a sole proprietorship or a partnership or an LLC or even a corporation? Have you gone to that extent? So we want to spend just a tad bit of time talking about each one of these particular types of structures and how they might apply to you and whether or not it might be a good fit for you. The first is the most common. Most real estate licensees are sole proprietors. That is the legal definition that the IRS uses for someone who has not created any sort of entity. Now, One of the pluses, obviously, of being a sole proprietor or operating as a partnership, because that's treated the same as a sole proprietorship, one of the major advantages there is ease. There's nothing extra to do. There's no paperwork to fill out. There's no anything to worry about. And so when you operate as a sole proprietor, there's definitely the ease of just not having to do anything else. The downside is there's no separation. There's no level of protection for you if you operate as a sole proprietor, and so there's more risk associated in the sole proprietorship in some cases than maybe some other cases. Like, for example, taxes, all of the income becomes personal income from a taxation standpoint. From a liability standpoint, if a licensee were to be sued as a result of real estate transactions and they were formed as a sole proprietorship, then the licensee would be sued personally. And so there's definitely some downside to organizing in this fashion, and that's why a lot of licensees choose to go the route of an LLC or an SCorp rather than the sole proprietorship. This is sort of the the next step up, if you will, of organization. How do I upgrade my organizational status by one notch? And that would be with an LLC or an SCorp, most commonly the LLC. The IRS calls these pass-through entities. Pass-through simply means that the income is passed through to the person or persons who own the entity. But that's after all of the expenses have been accounted for. So the LLC allows the licensee to essentially take all of their income from real estate commissions and offset that income with the expenses that the licensee might have, all your licensing expenses, your Association of Realtor dues, your marketing expenses, your cell phone, all those things could be taken into account and would reduce the level of income that the LLC has at the end of the year. And rather than the LLC pay taxes on that income directly, it simply passes that income through to the owners of the LLC, who would pay taxes as individuals at that point. When you form yourself as an LLC, you're going to divide the owners up into either members or managers. Members have ownership but don't have the decision-making authority, whereas managers have both ownership and decision-making authority. So most licensees who form themselves as LLCs would be managers of their LLC. You could also go to the far extreme of forming yourself into a corporation. Corporations offer the highest level of protection for anybody who wants to seek out protection from a taxation and liability standpoint, because the corporation is really and truly completely separate from you as a person. However, they do require the greatest level of care in setting them up. They are complex. You would probably need an attorney to help you with the creation of a corporation, where you might be able to handle creation of an LLC on your own without representation from an attorney. You would probably also need a lot of help from a CPA in preparing the tax returns for a corporation, because the corporation is going to be taxed as a separate entity. But the trade-off, the benefit to having all of those frustrations is the corporations certainly offer the greatest level of taxation benefit and protection for licensees who choose to go that route. Some firms obviously might choose to organize themselves as corporations in our industry. Our focus in this session is primarily going to be on the 2017 Tax Cut and Jobs Act, which was passed into law back in 2017 and went into effect for the 2018 tax year, and is, of course, in effect now for the 2019 tax year. So we now have 1 year of this law being in effect, and we're moving forward into year number 2. And there are lots of changes, and some of them are pretty significant changes for licensees about how they handle their taxes and those issues surrounding their taxes. When we talk about the 2017 Tax Act, one of the major changes, if you are organized as a corporation, this first bullet point is hugely important for you. Your corporate tax rate would have been reduced from 35% all the way down to 21%, which is, of course, a tremendous reduction. It's a reduction of about of more than a third of the total tax burden that was on corporations. And so if you have organized yourself into a corporation, this would have a huge and instant impact on how you file your taxes and how much you pay in annual taxes. But the truth is we just don't have very many licensees who are organized as corporations, and so this has relatively little impact on us as an industry. Where we start to really see the impact is with those pass-through entities, those LLCs, those SCorps. Those are where the impacts become very large for licensees, for people who are service professionals like real estate brokers. Anybody who has organized themselves into an LLC or to an S-Corp for tax purposes does not benefit from the corporate tax reduction. So that drop from 35% down to 21% didn't help, so to speak, real estate licensees very much because most of them simply were not organized in that faction. If you weren't a corporation, you didn't participate in any of the benefits that came as a result of the reduction in the corporate income tax rate. This is where being a member of the National Association of Realtors has huge impact on your career and how you practice your business. NAR argued through RPAC, the Realtor Political Action Committee, argued that this was an unfair treatment of real estate brokers, that the real estate industry, while mostly not organized as corporations, certainly represented a huge portion of the corporate landscape, even though they weren't necessarily organized as corporations, that there was such an integral part of the business structure in this country that there should be some help for real estate licensees. And so Congress went back to the drawing board and created some things that definitely would have been beneficial for real estate licensees. They created an exemption for something called a personal service business. Now, a personal service business is one in which the primary service that was provided is provided by an individual. And obviously, that really includes the vast majority of real estate brokers and real estate agents, that our product is us. I am my own product. I am what my clients come for in a transaction. The vast majority of clients, whether they be buyers or sellers, would tell you very bluntly that they are loyal to the licensee, that they have come to that particular licensee because of the expertise that that licensee can offer them, because of the professionalism of that particular licensee. Well, as shocking as it may sound, originally this definition of a personal service business did not include real estate professionals. As a matter of fact, we were specifically excluded from the original version of this act as real estate, as personal service businesses. And so again, NAR went back to the drawing board, and RPAC really pushed hard with the elected representatives in Washington, and eventually did get an exemption in the law. and it has been passed into the law, that the provision of real estate brokerage services indeed is a personal service business, and therefore met this definition for purposes of the law. Here's why this is so important. Every personal service business is now allowed a 20% deduction for top-line expenses. And so that 20% deduction that now comes into play for us as realtors allows us to write off a very significant portion of our business expenses, and thereby limiting our tax liabilities as real estate licensees, agents, and brokers across the country. So that 20% deduction applies to sole proprietors, partnerships, and LLCs who provide real estate services as pushed for by the National Association of Realtors. And so this will apply to any licensee who has a personal taxable income of less than $157,500. So if your personal taxable income is less than that amount, $157,500, then you're going to get the full value of this 20% deduction for real estate service professionals. If your income does exceed $157,500, then it's going to start to phase out. You're going to start to lose the value of that deduction to some extent, up to $207,500 in taxable income, and then that deduction would go away completely if you end up with a taxable income of more than $207,500. You would, in essence, not be able to participate in this deduction. But if you think about that, 20% right off the top is and this is in addition to the other business expenses that you may claim during the year. So we're not talking about, just some people have said, well, I already write off more than 20% of my commission income as business expenses. This is in addition to the other expenses that you may be writing off. So once you've taken a look at your tax return and you have deducted for business-related expenses, like your communication expenses, your mileage, your travel-related expenses related to real estate brokerage, your signage, your business cards, your all your membership fees. Once you've deducted all of those and you've come up with a new taxable income, then you can take that 20% deduction in addition to. And so it is a really huge benefit for the real estate licensee in minimizing their taxable income and thereby minimizing your tax liability at the end of the year when you do come along and file those income taxes. One of the things that has changed most substantially in the 2017 Tax Cut and Jobs Act is that the deduction for vehicles has been adjusted. Kathy asked a question, and I'll back up the slides as we're talking about it. Does that 20% deduction apply to SCorps as well? It does. It applies to all sole proprietors, partnerships, LLCs, and SCorps who provide real estate services. So basically, if you are structured as a corporation, you're going to see the tax benefit of having your effective rate go from 35% down to 21%. But anybody else who's a real estate professional would be subject to this 20% deduction. So yes, those of you who have an S-Corp, and I realize that's not on the slide there, but those of you that have an S-Corp as well would be able to take the benefit of that 20% deduction. So that's a big benefit. As far as the vehicle deduction goes, there have taken a new approach to something called bonus depreciation on very large vehicles. And when we say very large vehicles, we actually mean the kind of SUVs that many real estate professionals already drive and or would purchase anyway. These are considered to be larger than passenger vehicles, but the IRS cutoff for them is a weight-based cutoff. It's a 6,000-pound weight-based cutoff. And many full-size truck-based SUVs actually fall into this category. So if you have a full-size SUV that's based on like a truck body, so like a, I hate to be brand specific, but a Tahoe, for example, or an Excursion if you wanted to look at a Ford-type version, or a Lincoln Navigator or a Cadillac Escalade. Those are very large, full-size SUVs that would exceed the 6,000-pound curb weight limit. Now, I have to point out, it's 6,000 pounds empty. You can't have you and your friends pile into the car and weigh it at some weigh station on the side of the road and say, oh, my car's over 6,000 pounds. That's not going to work as far as the IRS is concerned. They actually have a specific list of vehicles that you can consult over at irs.gov if you'd like to take a look at what the specific vehicles are and their curb weights that would apply to this. But here's the benefit. If you have one of these vehicles, or if you don't and you're thinking about purchasing one, you might consider purchasing one that weighs over 6,000 pounds. And here's why. If you do, the current version of this tax law allows you to depreciate 100% of the purchase price in the year of purchase. Now, you think about the cost of some of these full-size SUVs, like, just take that Cadillac Escalade, for example. That car might have a $90,000 purchase price. That can be written off as depreciation as a single line item entry now for 100% of the value of the vehicle in the year you bought it. So if you had taken all of your other tax-related deductions for the year, for your LLC, your SCorp, your sole proprietorship, and you still had a taxable income of $90,000, you could, in theory, go out and buy yourself that $90,000 Escalade and write off the full value of the purchase price and claim an income of $0 because you would depreciate that vehicle all the way down to zero in the year of its purchase. So that would allow for some pretty huge, quite honestly, deductions for real estate professionals as a result of this accelerated or bonus depreciation that they call it. And so it allows you to go out and purchase a new vehicle if you want to and write off the full purchase price in 1 year versus spreading it out over the course of many years. Now, there are other bonus depreciations that apply to other types of vehicles, and this would apply to any passenger vehicles or any vehicles that don't meet up to that 6,000-pound limit. And remember, this is also in addition to the deductions taken from mileage. It's not in lieu of or instead of writing off your mileage. You still would get to take the mileage-based deductions in addition to the deduction for the depreciation on the vehicle. So any vehicle placed in service after September of 2017 could fall into this particular bonus depreciation category. So that's a major one. If you look at smaller vehicles, passenger vehicle depreciation has also been accelerated, just not nearly to the extent of those large vehicles. So if we look at passenger vehicles and how they have been accelerated, I've given you an idea here of how that might work. If you have a passenger vehicle that's less than 6,000 pounds that you go out and purchase now, according to this law, you could write off $10,000 in depreciation in year one, $16,000 in year two, $9,600 in year three, and $5,760 in year four, and subsequent years until you had depreciated it down to zero, of course, if you kept the vehicle that long. So still a big deduction, just not nearly the deduction that you might receive if you went the route of purchasing one of those vehicles with a curb weight of over 6,000 pounds. I certainly did go out and look to see how much my vehicle weighed when I read all of the various details of this tax law and happened to drive a vehicle that exceeded 6,000 pounds, but of course I already had it before this tax law went into effect, so I had to weigh out, did it make sense to purchase maybe a new version of the same vehicle after the tax law went into effect, and that's ultimately what I decided to do, to be able to take advantage of that deduction, because that's a huge change for a positive, and we certainly know real estate agents like to have nice cars in a lot of cases to take clients around in and make that statement, and so anything that relates to vehicle depreciation with real estate brokers is likely to get our antenna up, so to speak. So that's a big deduction you might consider as the year moves forward for you. Unfortunately, all the news, as they say, is not necessarily good news when it comes to tax deductions and how they are applied to your business expenses. The business deduction that relates to entertaining has now been eliminated. I know in the past many of you as real estate licensees have maybe joined particular clubs, for example, maybe a country club or maybe a social club or maybe a business-related club, and have written off the expense of joining that club as a business expense because you might entertain clients by taking them out to the golf course. Or maybe you've bought sports tickets. I certainly know friends in the real estate industry. I am a big college sports fan because I played football in college and worked in college athletics for several years. While I use my season tickets for myself and my family, I certainly know other friends in the business who have season tickets to sporting events who use them as gifts for clients and or ways to generate business. And, of course, you'd want to look at RESPA and all the regulations that go along with that if we're talking about residential clients, so don't run out and give those gifts away anyhow without looking at those restrictions. But, you know, there could be types of clients that wouldn't be so restricted by laws, you know, like commercial real estate clients or property management clients, for example, or just building relationships if you're a broker and you're taking people out recruiting or you're entertaining them for those purposes. There are lots of reasons that business professionals, including real estate brokers, have used entertainment expenses as valid business expenses over the years. Well, that has been eliminated. That is no longer a tax-deductible expense for any business professional, including real estate brokers. So if you have joined the local country club and counted on the fact that you could deduct those expenses as a business expense in the past, please do not count on it as a business deduction moving forward in the future because it will be disallowed. That is no longer something that you can write off as a business expense. So that's a definite change that went in the other direction on this law. The meal deduction and deducting expenses for feeding people, that sort of thing, has remained largely the same. Generally speaking, for many years now, we as real estate brokers have been able to deduct the cost of meals at a 50% rate for taking clients out, entertaining them with food, for example. Keep in mind, alcohol is not deductible, has not been for many years, so you should always ask for the alcohol, if there is any, to be on a separate receipt and pay for that separately. But if you wanted to deduct cost of meals for taking clients out to lunch while you're showing them around, for example, or to dinner, that is fine, and that deduction remains unchanged largely as it has been for many years now at 50%. That deduction sits at 50%. So, for example, if you take clients out to dinner and the bill is $100 without alcohol, exclusive of the alcohol, you can't include the gratuity, so include the taxes and the gratuity there. But if the meal is $100, you could write off $50 of that as a business expense, and that remains exactly the same. That remains unchanged under this law, so you can still do that. And also, interestingly enough, there are still provisions, and I don't have it on the slide here, but there are still provisions for being able to write off 100% of events that have food related to them. So like if you have a client appreciation event, then 100% of the food cost for that could be, just not for your normal everyday dining out and taking a client out to dinner. You still have to stick with the 50%. But if you do things like client appreciation events, or of course if you do community events where you're donating food or something like that, then you could write those off at 100% of their total cost against your tax burden. So nothing's really changed on the front of deducting meals. The big changes that have come along there were on the entertainment expenses front of things. That keep in mind, you just cannot take that deduction any longer for the cost of entertainment expenses. So theater tickets, sporting tickets, you want to take them out. If you want to take that client to dinner and a show, that's great. Just keep in mind that the show part is no longer tax deductible. I was asked the question last week, well, what about dinner theater? I don't know. I suppose you would have to ask for the establishment to provide you with a separate receipt that showed the value of the food, and then you could deduct 50% of that. But I do know that in general any type of entertainment expense has been disallowed, so that's something to certainly keep in mind as you go through navigating these waters. One of the most important things I think a real estate agent or licensee can do when they look at, how do I figure out what my tax burden is? I don't even know where to begin. Obviously, hire a professional. You need to hire a CPA, somebody who's going to be experienced and understand the implications of these laws, to make sure that you're not going too far with your deductions, to make sure that you're looking at things in a rational way so that you're not getting yourself, into trouble or have the potential for an audit. Nobody wants to see that happen. That goes, I think, as a pretty obvious piece of advice to hire a professional. But the other big thing that you can do for yourself, and I'm sure your accountant will thank you for it, that professional that you hire will be very grateful for it, is to come up with some technical assistance, some technological aid in keeping records, because there are lots of great software programs out there that are built to help you keep track of these expenses so that you do not have to do this all on the back of a napkin and shove it in the glove compartment of your car and keep that for when you want to take everything to the accountant the following year to do your taxes. There are apps that you can download onto your phones. There are pieces of gear you can buy. Certain GPS systems have tax tracking software built into them. There are software to help you track meal expenses, and there's software that will help you assign expenses to your clients. There's software that will tie in with your CRM systems in such a way that as you go through and work with your clients and take them out on showings and take them to view properties, you can also assign the mileage directly to that client, or you can assign that meal, that lunch that you just took them to, directly to that client, so you have a much more clear picture of the record keeping when it comes time to do your taxes. One of the great issues with doing taxes is we rely on records that we kept for a year or more previously to complete our tax returns. And quite honestly, some of us just do a poor job of record keeping. So please leverage the potential assistance that you have available to you in the form of these different apps and different software programs, because they're out there and they are readily available. I've got a couple of them here that I wanted to just talk to you about briefly and give you an idea of some of the ones that are available to you out there, so that you might take advantage of them. One of the programs that a lot of real estate agents around the country that I've encountered in traveling and teaching, a lot of real estate agents are using a program called MileIQ. MileIQ has one great advantage that a lot of real estate brokers love, quite bluntly, and that's the first word in that first bullet point, free. That always gets everybody's attention. The word free, and it is free. This is a primarily free platform. There is a paid version, but the free platform allows you to track mileage, and this is a mileage tracker. It's not a full sort of suite of things that allows you to track everything about your clients and what you're spending, but it does track mileage, and it tracks up to 40 trips per month. So that's 40 round trips, so there and back, per month for free on the free version. And, of course, you can kind of group the trips together if you want to keep, like, these 5 trips were for Jane Smith, and these 6 trips were for, Bob the buyer sort of thing, so that you can do some basic sort of housekeeping and management functions when it comes to keeping track of your mileage. Now, if you find that you like MileIQ and you like its interface, and it's available on both Android and the Apple iOS system, it's a phone-based tech. If you find that you like their interface and you're doing more than 40 trips in a month, then you can probably spring for the $6 that it costs to get the paid version of the app. And if you're doing more than 40 trips a month for real estate-related activity, you should either be able to afford the $6, or you should really work on who you're spending your time with on those 40 trips, because hopefully if you're doing 40 trips a month, you're also having some success and making some money and having some closings, so $6 is not too much to ask to be able to track more than 40 trips. Other agents have gone to a platform called Hurdler, and again, I am not specifically recommending or advocating for these. I'm just giving you ones that are more popular than others. Hurdler is another mileage tracking app. It has the advantage of being fully automatic. You can just sort of turn it on, and it senses where you've been, where you're going, and then you can come back after the fact and pick out a segment of a trip and say, oh, this belongs to that client, and track it in that way. And again, our favorite word here, this is a free platform. It allows people to track for free their mileage, and I think your CPA will be your biggest fan if you would navigate by one of these programs so that you can at least track your mileage. Now, should you decide that you really want to go whole hog, so to speak, in tracking expenses, tracking mileage, keeping detailed records so that you're not missing a single deduction at the end of the year, and you have the best possible sort of verification for things, then you could go with QuickBooks Self-Employed or something like it. A lot of licensees already use QuickBooks to do their taxes anyway and track expenses and income. In any case, the QuickBooks Self-Employed version has an app that fully integrates with your normal QuickBooks, and it automatically tracks miles and expenses and imports them into your normal QuickBooks accounting It's a much more seamless process. You're not sort of working in 3 different environments and having to take the data from one place and put it into another place. This really allows this sort of set it and forget it type approach. And it is a lot more full-featured. It allows you to sort them in a lot of different categories. It allows you to quickly identify with one click when you're on a trip, is this a personal trip or a business trip, so that it will, differentiate those out for you sort of on the fly. It will also do a really nice comparison at the end of the year that will tell you whether you should be taking the standard mileage deduction based on the miles driven or your actual cost, because it will keep up with your actual cost, the depreciation portion of the actual cost, the fuel cost, the cost of the oil changes and tire rotations, and so it will track those actual costs as well as track the mileage and then say, okay, well, you're better taking this version of the deduction versus that version of the deduction. With all of those features comes the heftiest price tag. The good news is that's still not an unnecessarily high price tag. This costs at $10 a month. I think it's $9.98 to be specific, but $10 a month for the QuickBooks Self-Employed, and you'll have really detailed control over navigating your expenses and your income. Hopefully, you've seen at least one thing in this presentation that leads you to believe there's going to be some relief headed toward you as a result of changes in the tax law. We know that it's never going to be perfect for everyone, but we certainly hope that everyone finds at least something they can find alike in there. And so that brings us to the portion of the presentation where I ask if you have any questions that maybe didn't get at as we went along. I'm certainly open to those questions, and I know it's sometimes hard to put yourself out there and ask them in the chat boxes as we go along. But if you have those questions, feel free to continue to type them in the chat box, as that'll stay open for another couple of minutes here. And otherwise, I'm going to give you my contact information here, and you can feel free to email me and ask any questions that you may have. As I said, I want this to be your presentation. It's there for your benefit. The association has asked me to share this information so that it can be meaningful to you. And if you come up with questions, I am certainly available to try to help you answer those, and I would welcome hearing from you in the future. With that, I think I'm going to turn it back over to Kathy, and that's going to conclude our presentation for this afternoon, and I thank you for your time.
Anyone have any? Anyone have any questions that they haven't had a chance to answer yet?
There are no questions on the chat.
Okay.
Okay.
This virtual conference session has now concluded. Please close this window to exit out of the session and return to the main conference site to choose the next session to attend from day 1 agenda page. Thank you. You may now disconnect.